Okay, so this is part 3 of chapter 11, Behind the Supply Curve, analyzing costs and profitability decisions. Right. So far we've done a production function in part 1. Part 2, we defined fixed costs, variable costs, total cost, marginal cost. In this part, we're basically going to add the revenue side, right? Because the only way to know how much to produce is to compare something very specific about the revenues and the costs. And bottom line, it's going to be this statement right here that we talked about already in chapter 9. Keep producing as long as marginal revenue is greater than or equal to marginal cost. All right. So let's get into it. Okay, so here is the example that we left off with in part 2, right, where we had our production function. We had 0 workers, or 1, or 2, 3, or 4. How many books can be produced? We calculated the costs in part 2 of this video, part 2 for chapter 11. Then we calculate marginal cost. Change in total cost divided by change in quantity is marginal cost. Okay. So far there's been nothing about revenues. Well, let's talk about revenues, i.e. how much are we going to be able to sell the books for that we produce? So let's imagine that no matter how many workers we hire, and thus however many books we produce, imagine we can sell each book for a price of $7. Well, if that is the case, how many workers do we want to hire to maximize profit, right? That's what this is all about, and we're going to be analyzing the same kind of analysis in both chapters 12 and 13 in perfectly competitive markets and monopoly markets. Excuse me. So there's a couple ways you could get to this answer, right? And a very cumbersome way, right, is to basically just say, all right, no, by the way, the answer is 3 workers. Now, how could you get to that answer of 3 workers? Well, there's two main ways, right? We could get the answer by calculating how much revenue we would be making at each level of workforce and thus production. So the revenue's coming in at each of those 4, or actually I should say 5 levels of production, including 0 workers. Calculate the profit. To move this down for a second. Calculate the profit that we would anticipate that we would get. So the revenue minus the total cost at each level of production, and then simply pick the one where the profit is highest. So we could do that. But here that would take a while, and we have 5 levels of production. But imagine if we had 100 levels of production. Right? Imagine if we were deciding between 0 and 100 workers. Turns out the answer to the question of how many workers to hire, thus what level of out to produce, we don't have to worry about total cost column at all, right? In fact, all we have to worry about, or total revenue column for that matter at all, what do we have to worry about? Well, we can simply pick the last worker where the marginal cost per book is less than or equal to the price of $7. Now, how could it be that simple? Well, the price of $7 in this example, where we can sell as many books as we want for $7 each, well, that means that every time we sell an extra book, we have $7 more of revenue, which is our definition of marginal revenue. How much our revenue, our benefit, marginal benefit, right, from discussion in chapter 9, how much our benefit, our revenue, money coming in, goes up every time we sell a book. It is $7 each time, right? So in this example, that price of 7 equals marginal revenue. When we get to chapter 13, price and marginal revenue won't always be equal once the demand curve is downward sloping. But here we're saying, hey, we can sell as many books as we want for $7. So we want to basically keep producing as long as marginal revenue, which in this case is the price of $7, is greater than or equal to marginal cost. Well, if we hire 1 worker, marginal revenue is the $7. Marginal cost is 5. So yep, I'm going to hire them. Second one, yep, still 5. Third one, marginal revenue, right? The price is 7. Marginal cost, each extra book costs us an extra 6. We want to hire them. But the fourth worker we don't want to hire because the extra cost, how much our costs go up for those last 2 books, that fourth worker, right, going from production of 14 to 16 helps us produce, is costing us $11 per book, and we're only earning $7 per book, so our profit's going to go down if we make that. So we hire 3 workers. Now, let's kind of go through this, right, in a little bit more detail, right, by effectively filling in and actually doing this. We could get the answer by and kind of see why this complicated or cumbersome, I guess I should say, method of calculating, why the simplicity of this in terms of figuring out our profit maximizing level of production works. Right? So like I have in part 2, right, we're going to go to an Excel version of this. But I want to emphasize here, I would encourage everyone to try to fill in this table on their own because you need to be able to calculate all of these types of things. Right? So do the exact same. So practice doing what I'm about to do in Excel. Okay. So here's that same table. Again, production function information. We already calculated total cost and marginal cost. I kind of took out the piece where we actually calculated the marginal cost, but that's all from part 2 of the video, part 2 from chapter 1. So if we sell no books, well, it doesn't really matter what the price is because we didn't sell anything, but price per book is $7. And again, remember the assumption here is that no matter how many books we sell, the price, and emphasize, make sure you recognize and understand that price is always per book, right? If you go to the store and ask what's the price for something, it's not for 10 books or 14 books, it's for a book, right? If that's what the price tag is, how much the store is selling it to us for. Well, let's calculate our revenue at each level of production, right? So our revenue is price, how much we sell each book for, times the number of books, or if we sell no books, we ain't got no revenue, right? But if we sell 5 books, 5 times the price of 7, that means we're getting sales of $35, right? Actually, before I continue down the table here, right, it's going to be the same calculation. Let's go back to the quantity of 0 and calculate our profit. Well, total cost, I'm just going to repeat my column from over here, right? Because remember, it was $20 total cost, even if we didn't sell any books and even if we didn't have any workers, because we still have our fixed costs, right? We still had to pay for the stapler and we still had to pay for the pen, right? So it's still $20. So if we don't produce anything, our profit, revenue of 0 minus total cost. Whoops, that's not good. Why isn't that showing? There we go. Profit is a negative $20. So we're losing $20. So notice when you don't produce anything, if you're in business but you have your facilities, right? You have your factory. Your profit's not going to be 0. It's going to be the negative of your fixed costs, right? You're gonna lose money. So now let's move on to the next level of production. So do we want to produce do we want to hire 1 worker and produce 5 books? Will that make us better off than if we hire no workers and produce 0 books at with this factory? Well, remember the short answer was, hey, as long as marginal revenue, right? As long as marginal revenue is greater than or equal to marginal cost, right? We want to keep producing, right? So marginal revenue, well, that's the price. The revenue goes up by the $7 every time we sell a book. For the first 5 books, right, when we hire 1 worker, the marginal cost goes up by 5. So the simple answer, right? The simple answer from the slide says Yeah, keep producing. Right? Keep producing, because we're better off than if we don't hire that worker and produce those 5 books. Our total cost, right, is again from the old calculations from part 2 video. It's 10 bucks. I'm sorry, 45 bucks. And then if we take the same formula, revenue minus total cost, gives us our profit. Now notice we're still losing money, but notice we're losing less money, right? So even though it's not great, right? Our economic profit, because remember, we're always looking at economic profit unless it specifically says we're looking at accounting profit. Our economic profit is negative, but it's less negative than if we didn't make any books or have any workers. Now it changed by $10, right? Went from negative 20 to negative 10. Well, why did it change by $10? Well, because every time we sold an extra book, we brought in $7 extra, but it cost us $5 extra each of those extra books we produced. So for each of those 5 extra books that we produced, our profit increased by the 7 marginal revenue minus the marginal cost. Actually, let's stick that over here. Right? Marginal revenue, minus marginal cost. So that's how much our profit changes by every time we produce that extra book. Right? But since we're producing 5 extra books, every time for each of those, right, our profit goes up by the $2 times the 5 extra books, or profit goes up by $10. Right? So notice that calculation. I guess I will label these, right? So this is the marginal revenue minus marginal cost at that level of production. So, and this is that number. So let's say change in profit if we make those extra books. Okay. Oops. So it goes up by 10 bucks, right? So we're $10 better off. Now, would it make sense to stay in business if that's the best we could do? Well, no. But this is effectively a short-term analysis, right? We've decided, temporarily at least, we're in business, right? So we're not going out of business. We've decided at this point we're in business, and if we're in business, we're going to want to keep producing, or we want to produce at the level of production where we do the best we can. And if this was the best we could do, well, that's how much we'd want to produce. But if that didn't get any better over time, well, we'd want to go out of business. Right? So let's go to the next level of production. Right. Price times quantity gives us our revenue if we hire 2 workers and produce 10 books. Our total cost, which we calculated in the part 2 video of this chapter, 70 bucks. Revenue minus cost, profit, 0. Right, so profit of 0, because total revenue minus total cost is 0. Now, it again improved by $10 for the same reason it improved by $10 before, because what happened? Well, for the second worker, right, marginal revenue for each book minus the marginal cost for each book, right, is $2 again, right? The 7 minus the 5, so same as before. And here we have to make a slightly more complicated calculation of the change in profit. So here we have the marginal revenue, how much our profit goes up by each extra book. Emphasize extra book that the second worker helps us produce. So that number is not on this slide, so we have to calculate that extra $2 times, well, 10 books for 2 workers minus the 5 books for one worker. So that second worker helps us produce 5 extra books. So profit improves or changes by a positive $10. So again, yep, we want to hire the second worker. Now, zero profit, zero economic profit. If that was the best we could do, would we want to stay in business? Many of you's initial, as you read this, or as I ask that question, initial response might be no. But in fact, the answer is yes. Because what's true of zero economic profit? Zero economic profit is enough. That means we have enough accounting profit to cover our implicit costs, right? Stuff that we talked about in chapter 9, right? So economic profit, it already reflects not just the accounting profit that we report on our financial statements if we were a company, but it also subtracts out what we would be doing instead if we didn't have this company, or let's say the salary we'd be making at another company if we chose not to be in business. So at zero economic profit, we were doing just as well with this book factory as we would if we took the next best choice, let's say a job. Okay. But let's keep going since that's not the best we can do in this example. So same thing, revenue, price times quantity. So we get a revenue of $98, total cost of $94, revenue minus cost, $4. So now we have a positive economic profit. So better off, right? We're doing better if we hire the third worker than if we stopped at 2 workers. Why did the profit increase, right? Why did it increase by $4? Well, same calculation we did before. So marginal revenue. So each extra book we sell that third worker helps us produce makes us $7 extra of revenue, but we have a marginal cost. Each of those 4 extra books costs an extra $6. So let's change the format so it's the same. Each extra book that the third worker helps us produce, we get our profit increases by $1, the difference between marginal revenue and marginal cost. Now, since we're only producing 4 extra books now, right, at that $1 marginal revenue, $1 times the extra 4 books, increase in profit of $4. That's where that number comes from. Okay. So again, keep producing because marginal revenue, right? This is going to be true for this chapter and the next chapter and the next chapter, right? Marginal revenue, as long as it's greater than or equal to marginal cost, that means we're going to increase profit by producing those books. Okay. And then the last example, right? The last worker, price times quantity, $112 of revenue. So $112 of revenue, total cost, $116. So total profit of negative $4. So why is profit went down by $8 if we hire the 4th worker? Well, the 4th worker only helped us produce 2 extra books. So the marginal cost per book got a lot more expensive, right? So what is our difference between marginal revenue and marginal cost? Well, marginal revenue, $7, not times, minus marginal cost. Each extra book costs us an extra $11 for that when we hire that 4th worker. So each extra book, the 2 extra books, each of them makes a profit go down by $4, marginal revenue minus marginal cost. And again, because that's 2 books, right? The change in production, so the 16 minus the 14. Our profit goes down by $8 from positive 4 to negative 4. Okay. So basically I went through this whole analysis to just basically try to prove, and the next slide has it all calculated that we just did in that on that example, to basically prove that this is enough, right? If we didn't do all those calculations, you couldn't tell me without these calculations that we did just now and that's populated on this slide, you wouldn't be able to tell me how much profit we made when we hire 3 workers and sell 14 books. If we just did what's on the left-hand side here, we just pick the last worker where marginal revenue is greater than or equal to marginal cost, right? But you would be able to, without doing any of those calculations, tell me that that level of profit, whatever it is going to be the best we can do. Because think about this until it's intuitive, right? If I tell you that, think back to the birdhouse example. If you make one more birdhouse, you can sell it for $60. If your cost to make that birdhouse, your total cost goes up by $40, do you want to make the birdhouse? Yeah, because your revenue goes up by, which is your marginal revenue, by more than your costs go up by. As long as that's true, you want to keep producing. And that's basically all that we just calculated. Okay, so that's it for this. Part 4, we're going to talk about different average costs and then come up with basically putting that stuff on a graph, which is going to be important when we get to chapters 12 on perfect competition and chapter 13 on monopoly.